He's a finance major, and he's here today to talk to us about the spreadsheets that you're going to be filling out for your business plans.
There are two main reasons why having financial statements are essential. For one, taxes. There are only two things guaranteed in life: paying taxes and death, unfortunately. So yeah, taxes for one, because you have to make sure the government knows exactly what you're paying so you can pay your taxes. And for two, for strategic planning. So you have to know, you have to be able to track, are you generating a profit? Are you generating a loss? Am I stable? Am I not stable? And so those are essentially the main two things that you get from preparing financial statements and doing financial analysis and analyzing financial documents and things of that nature. So there are you guys have three main financial statements: the income statement, balance sheet, cash flow statements. And there's another one, but that one's called a statement of retained earnings. So essentially what your income statement is, it is a statement of change. It measures change from one time to another, from one period to another. Generally speaking, because in accounting we have what's called a periodicity principle. That's not really important, that's just, but essentially what that means is that you account or you group periods of time in an arbitrary fashion. So usually that's for a year. So from January 1st to December 31st, that's one accounting period or accounting cycle. And so that's what you record your books. These are all of these statements are referred to like your books, particularly your balance sheet. So when you hear somebody say that, it's just like a lingo kind of thing. So your income statement measures change from the beginning of the year to the end of the year. It includes all your revenues, all your expenses, your net income, and so that's how you'll decide if, yes, I'm making money, I'm losing money, that sort of thing. And also on your income statement is possibly one of your biggest expenses, which are taxes. So that'll be on your income statement as well. That's usually for a business one of their biggest expenses, as well as collecting inventory. But depending upon the business that you have, you may provide service, or you may you may sell instruments, or you might fix instruments, which one is a service, one is a good. So you wouldn't have any inventory if your whole business is just a service business. The next financial statement is the balance sheet, or a statement of, another term for the income statement is statement of financial position. It's just different terms that people use. It kind of just depends on the person and the country that you're in. But this one is called the balance sheet. It lists all of your assets, liabilities, and your equity. So assets, that's kind of all your inventory, all your cash, anything that you could use to say, I have something of value. Liabilities, anything that you owe to outsiders that is not part of your business. Actually, it could be a part of your business, but anything that you owe anybody to. So owner's equity is literally just everything remaining after that. So let's say hypothetically you get a loan from a bank to purchase your business. Your business costs $300,000. You get a loan for $200,000, and you already have saved up $100,000. I should have probably explained the accounting equation first, but before essentially the $100,000, since that is your own money that you put forward, that is the equity that you have in your business. That is the part that you own of the business yourself. Does everybody know what the term collateral means by chance? Collateral? Okay, so if you don't know what collateral is, it's essentially when you get a loan, it's kind of like a safeguard for the bank saying, hey, if you default on this loan, this is what I'll take this back. So your house, if you get a mortgage loan, your house is your collateral. If you get a car loan, your car is your collateral. They can always take it back. So if you purchase your new music shop, your new whatever entrepreneurial mission that you are going to embark upon, and you pay, it costs $300,000, and you get a $200,000 loan. That loan is the $200,000 is your liability. The $100,000 that you put in yourself is the equity that you have in your own business. So that kind of what that leads to, which leads me to another thing referring to the balance sheet. It is the one thing that you kind of have to remember, and it is the accounting equation. It is the most important thing about accounting, and it always has to be correct. It leads accounting, so or in just general business in general. And so that is assets equals liabilities plus equity. So to go back to that example that I just gave, we purchased a $300,000 business. So that $300,000 goes over here. Now you pay $200,000 for a loan. And you had $100,000 of your own money. It always equals. So let's say for another instance, let's say, let's say you purchase inventory. So let's say you are a business that has inventory. So you purchase inventory for $100. But you also pay cash for it for $100 as well. It's equal. It always has to equal. Whether it's on one side or both sides. So if there's something on this side, there either has to be another equation or another subtraction or addition on this side, or it has to be on this side, and vice versa. It can never not equal to zero. Whatever you're adding always has to equal to zero. These net out to zero. If you put in $10,000 to put in a new roof for your building, that's addition of 10, but your assets also increase by 10 because you're adding value to because it's an asset to have a new roof. So it always will always equal each other. Yes?
Can you explain equity one more time?
So equity is the portion of the business that you own to yourself. It is so nobody else has a claim on the portion of the business that you own yourself. So stockholders' equity is essentially everything. If you move around the equation.
So it's like what you're paying for out of your pocket?
Essentially, yeah. It's money that you have, that you're putting into your business that's not coming from outsiders.
Okay.
It's everything. If you subtract liabilities from both sides of the equation, what you get is A minus L equals equity, or if you switch it around, equity equals assets minus liabilities. So if you take all your assets minus all your liabilities, what you owe to outsiders, you're left with your equity, which is what you put into your own business. That will always be the case. So equity will always equals assets minus liabilities, and that can go for anyway. It's another algebra equation. So you can make it assets minus equity equals your liabilities, or liabilities plus equity equals, well, that's the exact same thing, but you can always move it around to find exactly what you're trying to figure out for your business. So, and if you don't know, yes?
I was just wondering.
Oh, you were just, okay. So, but yeah, and so I think a good thing to note about the balance sheet is that it's always listed between current and long term, because when you're making, when you're buying, or when you're purchasing like a loan, well, you don't purchase a loan. When you're receiving a loan, some loans are for a year, some loans are for 5 years, 10 years, etc. And so it's important to know kind of to separate like your current liabilities, that's from within a year. So you're gonna know starting from January 1st, you're gonna pay these current liabilities, you have these bills coming up within this year. Long term, maybe 2 years, 5 years down the road, let's just say you're buying another building to expand your business, and it takes 5 years for you to do that. That is a long-term liability because you're constantly putting in money over, or having to pay money over a long period of time. So it's just so you can group everything in your own business, so you can know exactly what's going on and what, because it wouldn't make any sense to have all of this grumbled up because you have no idea what's currently going on. Do you have a question?
Can you explain that also with the assets? Like how do we differentiate current and fixed long-term assets?
Yeah. So current assets are anything that you can get rid of. That includes cash inventory because although let's just say like you have some damaged inventory, at least the idea is that you can quickly get rid of it even if you put it on sale. Long-term assets are anything that cannot get rid of quickly or that you intend to have for a long time. I don't know too many business owners that moves locations every year. I don't think that's a thing. If it were, then that would be extremely weird and I'd love to meet that person. But as of now, long-term assets is your property. If you have a car that you operate for your business, it's your car. Nobody replaces their car with intention every year. So those are always your fixed and long-term assets. And it's important, like I said, for the liabilities to group those together so you can know what's going on. Because it wouldn't make any sense to have some massive total for your assets when you have no idea what is what. When you have no idea how much of it is stuff that you can get rid of. Let's just say a huge liability is coming up. You just had some massive asset number. You have no idea what you have to work with. That's what's long-term, what's short-term for you to work with to pay off that liability or loan or whatever liability it is. But yeah, so yeah, that's literally that's long-term, short-term for both for both assets and liabilities. And owner's equity is just everything left over. It's like the change. Assets minus liabilities equals all your equity that you have in your business. So that sums up kind of. Does anybody have any questions on the balance sheet? Yes.
I guess it's just like for assets, you subtracted cash. So does that mean that's not something that's like can be taken away? Is that what that means, or like I guess I'm a little.
So for this, for that specific example that I use, we purchase inventory from a supplier or another business for $100. And we added, we purchased, so our supplies or our inventory increased, but we had to pay cash for it, so that also decreased. So both cash and inventory are both assets. So they will only deal with this side of the equation. And since you have to have I should have mentioned this rule, sorry, I apologize. Accounting will always have two entries, or finance, just general business will always have two entries. If you get, like I just said with that example, if you get inventory, nobody gives anything for free, you have to pay money for it. But inventory is an asset. It's right there. Inventory is a current asset that you can get rid of by selling it. Also, cash is an asset as well because you can pay for things that you have purchasing power with it. So if you increase one but decrease the other, the net, and they're the exact same amount, the net is zero, which that will always be the case with the accounting equation. It's called the accounting equation, but it's just the business equation, but that's just the formal name of it. But yeah, so that's why I said that, because if you, another example, like I go into a store and I purchase a musical instrument. I have on my balance sheet an asset for a $100 instrument. That goes away, but I also collect cash. So minus 100 and plus 100 all at the same time. There's always going to be two entries when you're dealing with something. If you get another liability, 9 times out of 10, your assets will also increase. Because if you're getting a loan, what are they giving you? An asset. They're giving you cash. So your liabilities will increase, so will your cash. Or if you're putting more money into your own business, your equity will increase. Your equity, oh God, it's Friday. Your equity will increase. Also, you're going to do something with that money. You're not just going to have it. I mean, you could have it sitting in your savings, but 9 times out of 10, you're going to invest that further and grow your business, buy more inventory, pay your staff, or what have you, or even pay off some debt. And so that'll probably go into your current assets because you're going to buy something with it, more inventory. So increase and then increase. And notice those are two different sides of the equation. So they are both, they're opposites. Sorry, yeah, wait, no, they're the same. Sorry, I said that wrong. All right, if they're on different sides of the equation, they have to be the same. It kind of doesn't matter as long as it nets out to zero, or it has to be two entries. So, So the statement of cash flow, well, I can't really talk about that now. Okay, wait, before I talk about that, do you want me to talk about breaking analysis?
Yeah.
Sure, alright.
There
Is there-
there might be a better reason behind this.
Behind
There's
it.
one right here.
Oh, found it.
Oh, yeah, I do. Much better.
Actually, I'm just gonna Google it, that makes life easier. Alright, so, let me skip that. So, if you do, or if you are in the business of selling things and you're not a service company, you obviously provide goods and you want to make profit off of that, whatever it is that you're selling. And this even works for service companies as well, because you still have to break even. It'll just be slightly different calculations. So, it's important to note that for this is the number of units, and this is the dollar amount. This line right here represents your revenue or income. So if you sell 0 units, you make $0. If you sell 500, you make $5,000. If you sell so on and so forth. In any sort of business, no matter what you are going, no matter what kind of business you have, you will always have fixed expenses versus variable expenses. Fixed costs or variable costs. Your fixed costs are the costs that will happen whether you sell $0 worth of inventory or $10 million of inventory. They do not vary, at least for the most part, they do not vary at all based upon the number. They are not related at all to the amount of products that you are producing, or to the amount that you sell, or to the amount of service that you provide. Then there's always a fixed level, which is represented by this red line right here. So in this particular case, their fixed costs are $15,000. What's included in the fixed costs? So if you have rent, if you have a lease on your facility that you're renting out, like on the square or something, more than likely they'll have you on a lease that you'll have to pay every single year until your contract renews. And assuming that you don't switch facilities, like I said, every single year, you're gonna have to pay that same person $1,000 or however much every single year or month, or however the contract is set up. So even if you completely shut down and you're not producing anybody, everybody has the flu and everybody's at home, you're still incurring costs. So that $1,000 for your rent is a fixed cost. No matter what, you have to pay it. Some other examples of some fixed costs are, well, it kind of just depends on the building. Some contracts may say your electricity bill, for instance, in some weird planet, maybe you have a cap for your fixed costs, and that's how much your electric bill will be for every single month. It'll never be like that, but that's just an example that I can come up with. So your fixed costs will always be a flat line because it'll never deviate for at least one accounting cycle. So for this year, your fixed costs are $15,000. Now next year, you may buy more stuff and you may have more expenses, and that line can move up and down depending upon the scope of your business and what you're choosing to do. You may want to grow, you may want to shrink. So that fixed cost number can always move, but at least for an accounting cycle, which is generally a year, it'll always stay at that horizontal line. So, this is, you can kind of interpret this as, so if these are your fixed costs, at bare minimum, you will always have to pay $15,000 a month or whatever the increment is. So if you're making things, you're going to incur more costs on top of that. So your variable cost is anything associated with producing your service or your product. So that may include labor. Labor is generally, if it's an hourly job, that's a variable cost because they can always get sick or go home, so that will always vary. So if your fixed cost is $15,000 a month and you are adding more expenses, logic says that you have to start here with your variable cost, and that's exactly what this blue line represents. this blue line represents your variable cost. It is actually your total cost because you can't start off anything below $15,000 because that's your fixed cost. Oh, by the way, I don't know if any of you guys remember algebra from high school, but this is not a function because both lines, because the rule is if you can draw a line and there's 2 points on it that is not a function, that all goes away in business. Yeah, everything breaks logic in business, unfortunately. But it makes sense, but algebraically it doesn't. So this is your fixed cost. This is your variable cost. And this is your income based on the amount of service or products that you're producing. So if you track your income with your variable, if you track, I'll go all the way up with your income line and also with your variable cost line, you'll eventually get to a point here in the middle. That point is your break-even point. From that point, you are not losing money, you're not gaining money, you're just kind of sitting neutral, which isn't a bad thing, but obviously the whole goal of your trying to make a business is to make money. So anything below this point, you are in the loss area. Anything above it, you are in the profit area. Do we have any questions for that? Yes.
Like, what kind of program do you use to do this?
So for small businesses, there are a bunch of different programs that you can use. The one that comes to the top of my head is QuickBooks. QuickBooks, I've heard that is really great for small businesses. They have desktop apps, they have mobile apps or iPad, tablet, whatever you have, and it'll track all your expenses. It'll create financial documents for you. It'll track essentially everything, all sorts of purchases that you're making, and it'll also collect your revenue. So that's the only one that I know personally, but I'm sure with a quick Google search, if you Google small business accounting systems, they will pop up.
Okay, sorry. So like before actually getting it done, like while like in like the stage that we're on, would QuickBooks be something worthwhile doing, or like do you wait? Like I guess I just don't know the time and what.
As far as when to get the system?
Yeah, like when do you like start? Because like right now it's all like, I feel like we're all guessing. And it's all like, you know, it's like hypotheticals, but like, so when would it be like lucrative to like
To get
do this? Yeah.
So you would need to track this as soon as your business starts. Like you would need to have everything as far as like as far as a system to track all your business before you actually have your business. From your very first transaction, you need to be able to say, did I lose money on? Well, you won't be able to say if I made money on your first transaction or not, because like I said at the beginning, it's based on the periodicity system, so it's based off of periods. So the only way you'll be able to tell if you're making money or not is through a set number, like a month or a quarter or a year. So that's how you'll be able to base that. But that should be set up before you have, depending upon the scope of your business, because every business is different. Some are a lot more complex than others, and some are not as complex. Yeah.
So do you mean, is there any tool that you can use now to help figure this out? Because like your doors are not going to be open just yet. Like once you are signed a lease and you're opening your business, you want to get QuickBooks and stuff. But for now, while it's hypothetical and you're trying to get a better grasp on these numbers, that's what you're saying.
Okay, I understand
Sorry.
that. That's a great question. Well, I would say it just kind of depends on your business. Like if you know exactly what you're going to be doing, like, because are you leaning towards more of a service or like a service or a product? Service. So yeah, that would definitely be slightly different because you don't have a single item that you can track. Hey, I paid this much for this. I paid this much for this, and that's how much I'm going to sell it for. I'm going to mark it at 30%. So I'm going to take this $100. It cost me $100. I'm going to sell it for $130. You can't necessarily do that. So it'll kind of be based upon you, how much you feel, how many people are going to be working for you. If it's just yourself, how much you feel like your time is valued. And trying to do like some models. So I would say if I'm going to be working for 5 hours, I'm going to say I'm going to charge $30 an hour, or however much the scope of your business is, and say, hey, so that's X amount of dollars this month. And if I have X amount of clients, which that's just kind of multiplication and subtraction of if I'm generating a profit or loss. That would be more hypothetical before you actually get into actually owning your business. Just some quick models on profits and loss. You wouldn't necessarily have to, well, you could do a break-even analysis. There are formulas that you can look up online, because the general formula for it is break-even. Wait, I have it here.
That would be
Fixed costs over the price minus the variable costs. So that's something that you can do, and it will be kind of tailored since they're service and not actual products. So I would just try to do like some general calculations to see if you'll be able to stay afloat and kind of predict the kind of expenses. Like if you know kind of a general location, kind of Google some lease prices and like say, okay, well this place is $500 a month, that kind of thing, to see like on a kind of a broad scope to see if it'll be plausible to accomplish.
I would also recommend getting a mentor. This is when we opened our store this fall, we sat down with somebody who had a spreadsheet for us to, and he helped us put the numbers where they needed to go, and then helped us interpret the sheet to say, this is how much you're projecting that you're going to spend each month, this is how much you think you can make with these conservative numbers, like you'll be fine, you should open your doors. And we couldn't have opened our doors without that person who has experience in this. So I think if you can find a mentor, either at the College of Business, maybe a connection over there, or we can help you do that, or someone who owns a business or is doing something similar to you and ask to pick their brain, and if you can check in with them every couple of weeks or something like that.
Yep. I
think that would be, and you have to do your own market research too, just to value what packages are you going to offer people for service, and then you have to have those numbers kind of decided, even though they might change once you actually open your doors, but you have to have something down to work with, and then adjust.
Anybody else have any questions about that?
Can you repeat that equation?
Oh, that was break even equals your fixed cost over your price minus variable costs.
Can we do an example together?
Double check that. Yeah, good price. So if your fixed cost on here says $15,000, let's say your variable cost is what, $3,000? Sure, why not? And your price for the object, or for the price in general, let's say, backwards. These numbers, okay, so, oh, that's not. Sorry. So that would be 15,000 over 2,000, which I believe is 7,500. Yeah.
What is your price?
So your price in this instance would be kind of that's kind of the total for all of for that whole month. Kind of. Well, I'm sorry. It's kind of weird. Okay. So that formula, it derives from another formula. So if you look up break even. Because there are multiple different formulas that you can use, so it just kind of depends. And then, because I can't really explain the other one, because contribution margin is a managerial accounting topic, so that would be another whole other hour lecture, unfortunately. But yeah, but the basis general of it, if you are selling a product, it would be easiest to do it on a per product level. So this is a price per unit, and this is the variable cost per unit. And then that'll give you the total number of dollars that you'll need to break even for that month.
What if you're selling multiple different things?
It'll be a weighted average for everything that you're selling. So a weighted average for the price and for the variable costs for that business. And there's different ways that you can do that as well.
So for Stephanie, like she has a venue and like bar,
Mhm.
so her variable cost would be like the number of drinks she sells and.
And it can be aggregate as well, or total. So that's why I said it would be like a weighted average between all the different products that you're selling. So if you have a $100 item, $50 item, meet in the middle, or vice versa. If you have 10 different items that you sell, then you would just take the weighted average for all the different items that you sell and just plug that into the equation. But yeah, so that kind of sums up break-even analysis. One thing that I did want to mention, though, is that there are a few different things that you guys as small business owners will have to not worry about, but like keep in mind. And the first thing is that there are a lot of different rules for following, like making your like these financial statements and everything. There are different rules that you guys will have to follow versus other forms of companies, because there's lots of regulations and things of that nature for like public companies and things like that you guys won't have to worry about. But I will say, even smaller businesses follows the same outline that larger businesses follows, and for the simple fact of getting more liabilities. But when I say that, I essentially mean getting loans. So when you go into a bank and you say, hey, I want to get a loan, I'm starting my own business, here's my historical data, if you're already in business, and you want to get an additional loan from the bank and you want to grow, they're going to ask, well, show me your books, let me see your balance sheet, let me see your income statement, your historical data on your business. And if it's not to a model that they are used to with other larger firms, they won't be able to necessarily look at it the same way. And so you want to make sure, and like if you have a QuickBooks or something like that, they generate it in that kind of same format. So when you're trying to get more additional funding for your business, they're going to want it to look in this kind of format. And if it's not something that they're used to with seeing if it's other bigger businesses, then you're at a disadvantage. Because they're going to want to see, if they're getting multiple loan applications a day, the one thing that you want to do is make their life harder and have me go in and actually look at it like this to kind of figure out what your business is doing. So you want to just have it in plain broad daylight, sales revenue, that much, this much, and that much. And so whenever you have these systems, they'll do that for you. So that's really important. So you're not required by law to have your stuff look like the other larger companies, but it's always, you want to get it as close as possible, just so for investor purposes. So if you try to get a loan or something like that, they have something reliable to depend on, to look at. And so another thing that I wanted to mention is that these all three have different names, but what's one thing that they all have in common? Any takers? They're all your own business. So the income statement shows you a change and is a change document. It measures your revenues and expenses, but what's going to be at the top? Company name. Balance sheet shows you your assets and liabilities and your equity. Well, what's at the top? The company name, and so forth, and so on and so forth. And I only say this to say that all these financial documents list different things, but they are of the same company, and it's like I think it's called a kaleidoscope, where you like look at it. I don't know. You're essentially taking a sphere and just turning it around and looking at different aspects of it. All of these financial documents, a lot of them have the same information. Like cash is on balance sheet for one, and it's also on statement of cash flows, where you're reconciling all your transactions throughout the year to decide to see what was your net cash, what does your cash do, and I'll get to the statement of cash flow in a second. So all you're doing with these financial documents is looking at your whole business as a whole and turning it around on different kind of angles and looking at it from different perspectives. Because every perspective leads to a different aha epiphany of like what's going on in your business. So from the income statement, you can tell, hey, I'm making this much of profit. Are my expenses getting too high? Do I need to control this a little bit more? Well, my revenues are really good, so that seems nice. But in proportion to my expenses, am I doing something wrong? Is there efficiency? Am I paying my employees enough money? Are my liabilities good? Like that kind of thing. So you're able to look by these kind of single line items and like look at the totals and kind of see, well, just kind of a general idea, like, well, hey, I'm only getting $100 in profit. And I'm operating, 20 days out of the month or so. So let's find a way to come up with strategic plans to increase that kind of stuff. So, and that's just kind of, yeah.
Before you go to the cash flow statement, I was wondering if you could just explain the difference between, or have a discussion about the difference between revenue and expenses versus assets and liabilities.
Yes. So revenues and expenses. So for when you're, I'm going to say this one more time, but I promise you don't need to know this. The periodicity principle states that everything has to be within arbitrary periods, which is essentially a year in most times. When you're doing your revenues and your expenses, your revenues is for that 1 year. And notice at this top it says for the year ending December 31st, 2017. That may seem like a small little detail, but this means that for the year ending, it started at January 1st. So this means that everything on this entire document was for that one period of time. This does not include anything else from any other period. That is what the balance sheet is for. The balance sheet is a permanent thing. So this rolls over from year to year to year. Income statement is for 1 year only. That is incredibly important. So for your revenues and expenses, these are all the revenues that you made for that year or month or whenever you're running these. Actually, no, it's for a year, sorry. So your revenue, your sales revenue, what you made, your other revenue, $400. Expenses, this is everything that you've incurred for that entire period of that year. And so that's how you get your net income. And so for assets and liabilities, which is on the balance sheet, those are permanent. So if you get a loan this year and you're like, well, hey, some person told me that is only for that year. And I don't have to pay this, right? They're gonna look at you kind of weird because that is not the case. If you get a liability, that is on the balance sheet, and so that is a permanent account until you pay it off. It does not go away. If you try to pull that and say, hey, no, this loan is an expense, and this expense is only for this year, they're going to look at you really weird because that is not true. So just keep that in mind. Revenues and expenses will always be on the income statement. Assets and liabilities are always going to be on the balance sheet. Speaking of which, it's important to note that there are two forms of accounting and finance, kind of. So there is the cash basis and accrual basis. Those are the two really main forms, actually the two only forms of accounting and finance. Essentially what that means is that when you go into a business, there are multiple ways there are two ways that it can happen. If I go into your business and I say, hi, my name is Devonte and I want to buy $5 worth of stuff. You can then say, okay, hi, how would you like to be paying? And my response will be, well, I can pay you back next week. If you decide to go ahead and give me my products, you've completed your half of the transaction. You've given me some products that I can use. On the other hand, I have yet to fulfill my part of the obligation and I haven't paid you yet. But since you've already given me your product, that you're going to realize, hey, I just did some business, right? So that is revenue. Revenue is not the same thing as cash. It is entirely different, depending upon what. So when you get into, this is kind of what I was mentioning before. When I said that when you go into a loan place and you're trying to get loans, they're going to want to see you. They're going to want to see your books, how other companies have it, and if you don't have it on accrual basis accounting, which is different than cash basis, you're going to have. I believe that there will possibly be more of a struggle. So essentially, the difference between cash basis and accrual basis accounting is cash basis is when you receive cash. You don't recognize any sort of revenue or anything at all until you see cash. Accrual basis accounting is once you perform a service or deliver a good or product to a customer, you are saying, I did business, I collected revenue. So that's the main difference between it. So I'm going to go back to that example. I walk into a store and I say, hi, I want $5 worth of stuff, but I can pay you back next week. You're going to say, okay, well my revenue just went up $10, but on my balance sheet, my cash did nothing. A week from now, when I collect that cash, my cash balance will go up. Versus cash basis accounting, I give them a product, nothing happens. And then a week later when I get the money, then my balance sheet automatically, oh look, I got cash. So it's just an easier way to keep track of your business and accrue the expenses and the revenues that you have for your business. Because it's a lot easier. It makes it a lot harder, but it also benefits you in the long run because you're able to easily keep track. Now, it may not sound like you may do this a lot where you just give somebody a product, and you may not. But especially depending upon the type of business that you own, it comes into play a lot. Yeah.
Like for us with our instrument repair store, people drop off their instruments, Tony gives them a quote, and then the instrument's sitting in our store until he can get to it. We don't get that cash yet, but we know we have this pile of hundreds, thousands, whatever it is, amount that's going to be coming because the person said, yes, I'm leaving my horn, I want it fixed. So that's an example of.
Yeah. So as of now, she has revenue sitting because it's an unspoken contract that she has agreed to fix that person's instrument, and that other person has agreed to pay them when they receive their instrument. So as soon as they fix it, she has performed her duty as a business owner, so she can say, hi, I have revenue of $100 that it took me to fix this instrument, and as soon as I get that cash, then I can also book that on my books. But if she were not to use that method, let's just say they never paid her, and so she did her work for nothing, and it's nowhere to be found. And there's constantly all sorts of, she's always, and let's just say for some reason, nobody ever paid her. There'll be nothing happening on any of her financial statements, because she doesn't use accrual-based accounting. So that can be kind of confusing. It really is confusing. Especially when you get into doing more like adjusting entries and that kind of stuff, that is way not important. Or it is important, but just not now. But so that's really the main difference between those forms of things. And you want to stick, like I said, you want to stick to using these types of financial statements that the general public uses to market yourself. Because when you go into ask for a loan or from whomever, they're going to say, show me your books, show me your records, show me everything that you have about your business or your business plan, and you want to have some solid, concrete stuff to show them. So there's
See the cash flow. Yeah.
Oh yeah, cash flow. Okay, sorry.
No. Good.
Yeah. Wait.
Or to the left.
I didn't even get to start with that.
That's okay. We did that.
So statement of cash flow. So remember how I just said accrual and cash basis accounting? Statement of cash flow converts your statement. Your statement of cash flow converts your accrual basis accounting to cash basis accounting. Business people like to make lives harder for all of us. So it is really confusing because you're just like, wait, you just said that accrual was the way to go, but now you want me to make this, and it's turning it back into cash basis, which is not widely used. The reason for that is because you're booking revenue, that is essentially, you're saying, hey, my business is doing good. But at the same time, you didn't collect any money. So she's gonna book on she's gonna put that she made $100 as soon as she finishes repairing that instrument and say, hi, I'm making money, I just made $100, but she hasn't yet to collect it. So because of that, that was not a cash flow. She didn't receive or give up cash. So your operations is from your day-to-day operations of your business and what you do every single day. So cash receipts from customers, and then that will be an additional $1,000 if she actually did receive that cash, and then cash paid for inventory purchases, and you're kind of like reconciling, or I guess kind of merging the two together, cash basis versus account accrual, to make sure that you get the net amount from cash. Because if you say that you have revenue for something but you haven't collected money for it, and it's the end of that period, so December 31st, then you can't say, oh, well, I still have the revenue, so it still counts. No, you have to reconcile it and say, hey, I didn't actually collect this yet. So that's more like a technical kind of thing, in my opinion. I can touch on this cost.
Or does anyone have questions? Yeah.
What is
Yeah.
cash at the beginning of the year? What does that mean? Cash at the beginning of the year?
Yeah, so notice income statement, cash flow, they are both change documents. That is really important to note. Change documents. Balance sheet, a single point in time. Income statement, cash flow, change documents. They measure change from one point to the end, particularly January 1st to December 31st. This is why it says for the year ending December 31st, 2017. Now it's also important to note, because you work on the periodicity principle from January 1st to December 31st, the beginning balance that you have for any sort of account is the ending balance that you have for the last year. So if your cash at the beginning of the year was $2,000, that means that the cash at the end of the last year was $2,000. Does that make sense? So everything rolls over, but they're not on the same document. So it's not what I say about not on the same document. They're not here. It's here. So it's a separate part. So this is where you're starting off at. So you start off with net cash, and you start off with cash in the bank or on hand on your person of $2,000 last year. And now subsequently, at the beginning of this year, on January 1st, you have $2,000. Does that make sense? And actually, technically in this case, it would be, January 1st of 2017. That was how much you had at the beginning of the year.
And now you have 800 at the end.
Yeah, now you have 800 at the end.
And that would be the
because all
number
of
you
this-
put on the next year's statement.
Yeah, and this would be at the beginning of the year for 2018, if that makes sense. So your ending balance will always be your beginning balance, and your beginning balance will always be your ending balance. So that's kind of how that works, but as time goes on.
What if we haven't started our business?
Then it'll be zero. Yeah, it will be zero. And that's for every document. Your beginning balance will always roll over to your ending, your ending balance will always roll over to your beginning and beginning to end, and it's a never-ending cycle until you go out of business, or you close your business, or you grow and things change. Yes?
So at the end of the next year, would you add that 800 to the 2,000 from the previous year, or?
Well, so it's important to note that this $2,000 is starting here. So that's where all this happens. So you would take that $2,000. This is cash receipts from customers. That means you're collecting cash. So that's 3,000. Wait.
Yeah, these are numbers that were on the sheet, so they might not.
Oh, I was gonna say this doesn't match up, but so that would be 1,000. Essentially. So you take that 2,000. That would be 3,000. Then you subtract general operating manager expenses. Yeah, none of this is filled in, so it won't match.
Yeah.
But let's just say this is like 2,000. Then it'll be 1,000 out here, or whatever the number is, and then that'll roll over to the next year. And then you'll start off from that, then do all the add, subtract, then total. Then that'll roll over to the next year. It's just constantly rolling over. And so the reason why I said that, it's time to go. I'm so sorry. But yeah, so there's that.
Thank you so much for coming.
You're welcome.